Okay. Just to kind of talk about a live frozen. I'll just tell you about liabilities a little bit. We talked so far about assets, about getting assets. A lot of times the liabilities go along with them. How do you get a new piece of equipment? Well, a lot of times you have to get financing from somewhere or whatever. So liabilities go along with it. So you get the assets on the one side of the balance sheet and the liabilities on the other. So the question is, well, how do you know whether the liabilities are um, misstated? And just in general, are you more worried about liabilities being misstated as being higher or lower than they should be? Are you more worried about them being overstated or understated? What do you think? It could be both. Yeah. It's possible that they want to avoid taxes. They want to make it look like they have more liabilities than they have. But for most companies, a lot of times you'll be more worried about it being understated. Yeah, that they are less than. And there's something else that kind of goes along with auditing that's a little bit, I don't want to say funny, but it's very difficult for somebody to sue you if the financial statements are actually better than what's being reported. And that's one of those weird things about auditing. Yeah, we look for both ways. Okay, are these overstated or are these understated? Um, but it's very difficult for somebody to have a case against you saying, well, you know, a bank, for instance, saying, well, you said that this company was making 300,000 and they're actually making 400,000. Like, well, okay, so your loan's more secure. What are your damages? Zero. Um, so you generally get, so that for that reason, you generally are more concerned about the financial statements being worse than they actually show rather than them being better. Rarely would you get sued if the financial statements turned out to be actually better than what they were reporting. Okay. Let's see here. Okay, so search for unrecorded liabilities. We talked about this a little bit, I think, before. Uh, ah, so cut off bank statement. Again, this is usually, if you recall from before, I'll sort of say an example. Um, made on one, oops, 14, 20, 23. So you get a cut off bank statement and payments in the following period may indicate liabilities. Okay, so payments early in the following period may indicate liabilities that are unrecorded at year end. So usually if you're paying something in, say, early January, that means that it was probably a liability that existed, um, on as of, say, 12/31. So if you're making payments early on, it could be that there's something came up that they have to pay for that happened in January that they have to pay for in January. That's a possibility, but it's also likely or possible that whatever payments that are being made, that there should be a corresponding liability to it. And if there isn't, you may want to look into seeing why there isn't. Okay, analytical procedures. How many phone bills should a company have in a year?
Well,
12. Medical received 11.
well, no, because at the beginning of the year, it's usually from
We're
the
auditing a business and they have phone expenses. How many phone bills should they have in a year usually?
12.
Oh, come on. How many phone bills do you get in a year?
12.
12. Can you hear us? I don't think you can hear us.
No, you know what? You guys can't, I can't hear you guys. I think that's the problem. Let me check something here. Oh, I know. You know what? I apologize. You guys are probably answering stuff that I can't hear. Give me 1 second. Let's see here. Okay, someone say something.
12.
Hello?
12.
12. We said 12. There we go.
You guys are probably yelling. What's wrong with that idiot? All right. Oops, don't want to do that. Let me do something here. I think it's annoying quick. No, there's no one in the classroom here, so I didn't turn on the projectors, and the projectors are what have the microphones on. Let me do something really quickly here, though. I want to turn off the sounds. But every time I click on something, it doesn't go bring, bring, bring. Okay, so back to my question that I'm sure you guys were already answering when how many phone bills did you have?
12.
12.
Yeah, so um, so one of the things you look for, and this is a let me get rid of all this other stuff. So when you're looking for, for unrecorded liabilities, one of the things you look for, okay, there should be 12 phone bills, should be 12 rent payments, there should be 12, whatever um, things that are paid monthly. Okay, so that's an analytical procedure. You're saying, okay, it's plausible that they should have 12 phone bills. Possible they don't, but there should be a good reason why they don't if they're, if there's overpaid or whatever it was. But okay, interest expense. And here's a scenario. ABC Corporation, it's only interest-bearing liabilities, a 5-year bank loan for $1 million. Bank confirmation shows an interest rate of 6%. ABC Corp's income statement shows interest expense totaling $94,000. Why would this interest expense concern the auditors? Can you guys hear that air rushing sound in this room? It sounds like a tornado or something going through here. Hopefully you can't hear it, but so what's the problem with this?
The correct amount cannot be in the account.
Yeah. If you look at, if you say, okay, well, let's take a look at the loan here, $1 million loan. Times 6%. You don't have to do this, but since it's for the entire year, let's say 12 times 12, if it was made partway through the year, whatever, you would look at it. So they should have interest expense of 60,000. Oops, that's too much. Hold on. Okay. So this is what they should have for interest expense, or something pretty close to it. So what's the danger if they have interest expense totaling 94,000? Oh, you guys can't hear sound?
Maybe they record another expense in that account.
Yeah,
Yeah, the
they're trying to
problem,
move money around.
the problem is they might be paying interest on something that is not being on the books. And notice the problem with interest is you're not
Or
going to,
paying interest of other assets.
yeah, yeah. So this is, if they're paying, an extra 34,000, they may very well have extra stuff on the books that they're paying interest on that they're not actually showing on the books. And maybe it is being put onto something else that doesn't show the interest being, as being an interest expense. They may have this may be a violation of the bank lending agreement too. You have to check into that. Here's a question for you. What if they are paying 94,000 and the 6% interest is the correct rate? What would be the likely amount of liability that they would interest bearing liability that they would have? Actually, I asked a question I don't know the answer to. Hold on. So if they have 94,000 and the interest rate 6%, what would be their likely oops, don't do that. I almost called somebody. So my calculator. Okay,
1,566,000.
yep. That's exactly it. Good. Yeah, if you take
94 divided by 6%, you get that amount.
yep, exactly. 94,000. If you're kind of like reversing, going from, instead of going this way, you're going to go take from the interest expense of 94,000 and then back into it. So you're going to say 94,000 divided by 0.06. And I should have made this a nice, an easier number to get at, but it's
1,566,667.
yeah, yeah. So this would be the likely, if the 6% is correct, and if that there is missing, maybe it may be understated by $566,000 or thereabouts. So this is one of those things. Again, this is an analytical procedure. It could show you that they are, that there's additional ones that should be on the books. You can also use it the other way too, though. For instance, let's say that they may show on the books that they have, $2 million and their interest expense is only 94,000. So, okay, with $2 million, it should be more than that, right? It should be 2 million times 6% is what, 120,000. So it can go the other way also. It could be that someone is loaning the money to the company at 0 interest rates. Why'd they be doing that? Well, maybe they're trying to sell it and try to make it look like it's more profitable than it really is. So you do have that problem that you may have someone like an owner or an investor that is loaning the money, trying to make the company look more profitable for whatever reason. So interest expense is actually can be quite useful as a analytical procedure. Doesn't necessarily mean that there's fraud, but it means that there's something you want to look at. Okay. Review the minutes of meetings. What are the minutes of the meetings?
When the audit committee sit, they state something that is rotten and have to follow to make if all the board meeting or audit committee have talked about is reflect in account.
Yeah, you're going to be the minutes are basically a recording of the meeting. So the minutes are let me write this in. And usually things like board of directors and things like that I'll say board of directors. And the reason why you want to get the board of director meetings is that usually if there's something big going on in the company, it goes up to the board of directors. And so oftentimes you want to get any notes. The minutes are just simply the notes of those meetings. So you can see what they discussed and what the outcome was, or what they decided to do with it. But the board of director meetings, and by the way, public accountants, certified public accountants will often sit in on board of director meetings. They'll have, all the board of directors will be there, and then you'll see a couple people over in the corner taking notes and playing with their phone or whatever. But it's not uncommon to have the auditors there, and there's nothing wrong with that. It's very common, and the reason is that, well, they're going to ask questions about it anyways. Maybe we'll have them there, and then we don't have any questions about it. So it's very common to have they'll definitely get the minutes from the meetings and review them, but they'll also a lot of times they'll actually just be there. Okay, identify loss contingencies. So loss contingencies, they're usually dependent. When we talk about like contingent fees, same thing. Contingency is dependent on some outcome. And that outcome is, has generally not happened yet. It could be a lawsuit. It could be attempted, a merger or something like that is waiting to be approved. It could be waiting to be approved. It could be waiting to go through. It could be working out details or whatever it is. So it's contingent on something else. And the problem is that the outcome hasn't happened yet. And so oftentimes these contingent liabilities are sort of difficult to estimate because it hasn't happened yet. It could be a merger, trying to go through the merger. It could be, like I say, a lawsuit. All those things are contingent on something happening. And it really can be difficult because there's actually two things going on there. There is the probability of it, and the amount. And sometimes the probability of it's difficult to find, or and the amount is sometimes really difficult to find. Years ago, there was a law case against, there was competing football teams in the 1980s in the United States, U.S. football, that they sued, saying that no, the NFL, which is the big U.S. Football thing, that they were a monopoly. And the outcome was that the court ruled they are a monopoly. They're absolutely a monopoly. However, the losses that that the other football league had were solely because of their own doing. Even though it is a monopoly, they won that part of the case. They said it was a monopoly, but there was no damages to it. So there's two things. There's the likelihood that, of the case being favorable or not favorable, but then there's also the dollar amounts could be very different. And just to let you know how that turned out, it's called the XFL. They won $1, which, because it's an antitrust suit, got tripled. It was $3. But yeah, so contingencies are difficult because again, it hasn't happened. A lot of times the difficulty part is the probability, and the dollar amounts can be very difficult too. Okay, litigation. This is obviously a big one. And oops. This is one of those things that is very focused in the U.S. Oops. Oops. So in the US, litigation is a huge concern compared to the rest of the world. Most places in the world don't have the legal system the United States have. You know, it's not uncommon to see millions and millions of dollars awarded to people for lawsuits. Someone gets hot coffee that's too hot or something, and you get these huge tens of millions of dollars that get awarded sometimes. And but that's usually specific to the United States. That's very different than most countries. In most countries, a lot of times the legal system is almost kind of like our accounting system. I mean, they say, okay, if this happened, then here's what you get. This is okay. This is, it's terrible that someone was injured or killed or whatever, but here's the parameters. You don't have these flashy lawyers and stuff that make these huge cases that are, like I say, worth tens of millions of dollars. So that is very unique to the United States. That's one of the unique things about our business, or actually just being in the United States, is the contingency that could exist there for legal stuff. And when you look at the U.S. standards, it reflects that. The U.S. standards are very much looking at the legal aspect of it, because again, our country is very different than the rest of the world. In the United States, someone sues a city and they get $8 million and everyone says hooray, but it's not usually like that in most places. It's a very different kind of a system. Okay, so loss contingencies, litigation is huge in the United States, and we'll talk about the lawyer letter later. Okay, general contingencies. So general contingencies are generally not disclosed on the financial statements. And these will oftentimes go along with whatever the business is. Okay. And just give you an idea, like fireworks. If you're a company that makes fireworks, well, fireworks are dangerous, they explode. Well, yeah, everybody knows that. Anyone who's investing in a fireworks company knows fireworks explode. It's like kind of the whole point of them. So those are things that's a general loss that could happen. That's a general part of being in the business. Auto companies, people drive cars, they drive they get in car accidents, whether it's the driver or the car failed or whatever it is. Those are just lawsuits that happen, and you generally don't book those because this is part of being in the auto industry, that people crash cars for whatever reason is part of the business. So general risks are not disclosed in the financial statements. People should know what kind of company they are. Okay, analytical procedures. Let's look at these. These are kind of big. Oops. Analytical procedures are required beginning, oops, and at the end of an audit. And analytical procedures are based on plausible relationships. They are not usually evidence themselves. What do I do here? Oh, I got an extra I in there. I'll clean this up in a second. Okay, so analytical procedures are not evidence of misstatements. So they themselves are not usually evidence of misstatements, but they indicate where the auditors should investigate. And something like 90+% of all fraud and misstatements are picked up through analytical procedures. They're required, though, at the beginning and at the end of the audit. So these are required. They're not optional. And it's because so much of fraud and misstatements are found by them. They're generally not evidence of themselves of misstatements, but they indicate where the auditors should investigate. Okay, so let's take a look at this problem down here below. So below are the unadjusted balances of the 3 accounts in 2023. Okay. So here's our 2023, here's 2022, the previous year. So the sales went down a little bit. Okay. So they went down some. Oops. Cost of goods sold went up. Okay, let's stop right there. Does that make sense? Oh, wait, I want extra 0 here. That certainly doesn't make sense. Do you guys have an extra 0 on yours?
Yes, we have an extra one too.
Okay, sorry. Being a little generous with the zeros there. Take that last 0 off. So yeah, that would be a very high cost of goods sold. I'll correct that. It won't help you guys, but future, you'll be glad to know that future accounting 433 students will not have to deal with that. Okay, so our sales go down, but our cost goods sold goes up. So what's unusual about that? If our sales were less, that probably means we sold less goods, but here it is going up. Now, is that evidence of fraud?
No, things could just be put into the wrong categories.
Could be put in the wrong category, or it could be that, hey, costs went up and we sold less things. It could also just be, we had to raise our prices and the cost went up and we sold less. There could be a very reasonable thing, but it also, when you look at it, say, okay, there might be a problem here, because you're right, it might be they have it in a different category. Okay, so they identified the cost of goods sold as an area of interest. Okay, so they said, okay, let's look at these cost of goods sold. Why are these cost of goods sold going up? The sales are down, the cost of goods sold went up. Let's take a look at them. Okay, so they went and they did their testing. During the audit, they determined the cost of goods sold was not materially misstated. However, the sales were materially misstated and should have been 1.2 million. Okay, so we found out that the culprit was not the cost of goods sold, that it was actually the sales. The sales were higher than they reported. They had understated their sales. So we tell them, look, you got to correct your sales, and they do. right? They say, okay, yeah, all right, we'll put the sales at 1.2 million. So we tell them to do this, probably, and they look at it and they say, okay, we'll do it. So here is the new adjusted balance. So they did what we told them, we asked them to do, and now this is what we have. I need more room here. Okay. So now, end of the audit, we're looking at this. Now what looks strange? They did what we asked them to do. We said, okay, the sales should be 1.2 million. They make the adjustment. What looks what looks strange now that we should look into maybe?
The selling expense.
Yeah. Yeah, now the selling expense looks strange. They're selling more things. Usually when your sales increase, your selling expenses increase. You have more advertising or you pay more commissions or whatever it is. Now the sales look fine and the cost of goods sold look fine, but now the selling expenses. So after the adjustment, you may go look back and say, okay, now the selling expenses need to be. So you basically do them at the end to make sure that the financial statements still make sense. That after you do the, where am I at here? Hold on. Let me get a little room here. I should say may need. Yeah, because the selling expenses now look strange. The sales go up, selling expenses go down. Okay, now selling expenses is the odd one. Cost of goods sold looks fine. Sales went up. Cost of goods sold went up. Now the selling expenses are. So this is one reason why we do it at different, at the beginning and at the end of the audit. Okay. Subsequent events. Well, let me say what subsequent events are just in general before I get into this. So subsequent events are things that happen after year end. So if their year end is 12/31, things that happen in January or February of the following. So these are things that happened after year end. They were not, they didn't have this information before year end. It only happened after year end. Subsequent event type 1. A type 1 subsequent event existed at year end. And now we just have more information. Okay, and I'll give you an example. This is the same one given down below, but Oops. It also settled on January 12th for 43,000. The client had booked a contingent liability for $50,000. Oops, let's try that again. $50,000. Oops. Okay, so the lawsuit was settled for 43,000 on January 12th. Now, the financial statements, they had made an estimate of 50,000 for the contingent liability. Now, the financial statements have not been issued yet. Okay, so here's this lawsuit. They booked it for 50,000. You know, that was an estimate. You know, maybe they knew that they were going to have to pay something, and they talked to the lawyer, and they said, "Yeah, 50,000." So they booked 50,000.
Reverse the 50,000 and they book the 43.
Yeah. What you may want to do is go back and say, okay, now we know that this is not a $50,000 liability. It's really only a I forgot what I wrote it now. It's really only a $43,000 liability. So this existed at year end. The contingent liability existed at year end. Now we just have more information, and so we can adjust that year end entry and say, okay, take out the 50,000, put in the 43, because now we know exactly what it's settled for. Okay, so this is it existed at year end, and this could be for almost anything that existed at year end. Now, if it's small enough, it could be that, if this is like someone like Walmart, they're probably not even going to bother to change the books. But if it was, $7,000 was a significant amount, you may have them go ahead and change it from 50,000 to 43,000. Okay, so it's going to event type 2 is for things that did not exist at year end. Oops. Give me 1 second. These events are for major changes in the operations or financial structure of a company. Okay, so this is not for little trivial things like we settled a lawsuit. This is when things are really big. So subsequent two events did not exist at year end. These are for major changes in the operation of the financial life. For example, ABC company sells let me think here. A business unit that accounted for 30% of the company's revenue. Okay. So company sells a business unit that accounted for 30% of the company's revenue on January 16th. Okay, so now notice they had this business unit on 12/31. So they have whatever business, let's say they made shoes and socks, and the socks business they sold, the socks accounted for 30% of their revenues, their sales. All right. It happened after year end. So the year end financial statements have the sock unit on them, right? Because they actually did own it on 12/31. But now we get in halfway through January, they've sold it. Now, here's the thing. People look at financial statements for future predictions, for future, to give some kind of an idea of how the company's going to do in the future. Notice if they're not aware of this, like, look, don't expect sales like we had last year because 30% of those are gone. And whatever money they got for selling this is also going to be on the books, and it's going to be a different company, basically. So type 2 events are usually when they're very large, they either have a big impact on the financial structure or on the operations of the place. And they're significant enough that the financial statements would be misleading if people didn't know about them. So look, if no one knew that they sold off 30% of the company, that would probably have an impact on their investing decisions and loaning whatever else they're going to have with this company. So these are for big things, and these generally get disclosed. They can get disclosed. They'll probably be disclosed. You insist they be disclosed in the footnotes, and they may also end up in the auditor report, saying, "Look, by the way, they sold 30% of the company, so plan appropriately." You're looking at these financial statements. They may even issue pro forma statements showing it without the business. Okay, so let's play. What type of subsequent event is it? Or is it a subsequent event? It might not be either of those. Okay, determine the subsequent event for the following. The client settled a lawsuit that was estimated at year end.
Type 1.
1A.
Yep. Number 2, we just talked about this. Company sold 40% of the company to an investor after year end.
Type 2.
Oh,
Type. Yep. 3, client introduced a new product after year end.
Neither.
Either. Yeah, companies, introduce products all the time. That's a usual thing for a company. So even if they they think it's going to be a good product or whatever, it doesn't matter. It's a part of the normal business. The client lost one of their 2 warehouses in a fire.
Neither.
Um,
Oh, well, type 2.
probably a type 2. It really depends on how big and how much it affects the business. Certainly if they lost a warehouse and they had 10 of them, it probably wouldn't be as big of a deal. But because there's only 2 of them, this may very well be a type 2. It is possible that it's not, isn't, if it's something they didn't need or weren't using. Client merged with a major competitor after year end.
Type 2.
Type 2.
2.
Yep. And again, so type 2 is only for big stuff. Type 1 is for things that already existed. And your run-of-the-mill stuff. So, if, for instance, another one that comes up is if you have let's say you have actually the auto companies were going through this. I don't think maybe they still are. They had a union strike. Well, if you're a company and you have a union, strikes are just part of the game. So, things like that are generally not, disclosed as type 1 or type 2. It's just part of the regular business, like introducing a product, like whatever it is. So, unless there's some unusual circumstance, those kind of things are generally not disclosed. Okay. My spacing got a little strange here. Date of the audit report.
Did the auditor sign the report?
Yep. It's dated as of the last day of field work. So the last day that you're on the job collecting evidence. Eh. So that is when, so for instance, I'll give you an example. So let's say that their last day of field work, let's say, was February 5th. And so that would be the date on the audit report, and the audit report would be signed as if it was that was the last day of field work. So that'll be the date that it's stamped on the audit report. Now, that is not the date that it is issued, at least not usually. I guess it could be, but the release date is after the
The audit committee.
yeah. So it's after the last day of field work. So I'll say that February 12th. So now February 12th will not appear on that audit report. Only the February 5th will show up on the audit report. So the release date is after the last day of field work. So here's what happens. You get all of your evidence. You say, okay, we have enough evidence now, we can form an opinion. Generally, you take all your evidence, you go back to the office, you talk with people in the office and they go over things, making sure that everything, you got all your ducks in a row. And they'll come up with an opinion. Okay, so you have this opinion on the financial statements based on it. But generally, when you're in the middle of the field work, there may be things that come up that you don't make a rash decision at that time what the opinion is going to be. So you go back and you talk about what it's going to be. So you form an opinion after the last day of field work, but it's based on evidence gathered up to that date. So up to February 5th, that is the date that you're basing your opinion on, the evidence gathered up until that date. Generally speaking, after the date of February 5th, the auditor is not required to look for, I should put this up here on this one. I just say generally. Okay, so that's the significance of it. Are we missing a Y here? Okay, so the auditors are generally not required to look for evidence after the last day of field work. So something happens on February 5th, 6th, 7th, whatever, you get the idea. They're generally not on the hook for it. Now, if things do come up before the release date, it's possible that things are discovered. So, let's say that we have a major merger or something that happens on February 8th. The auditors become aware of it. And so the auditors think, okay, we need to put this, this has to be part of the audit because there's this big merger that happened on February 8th. It's after our last day of field work, but we've become aware of it. Okay, what do we do with that? we could change the date of the field work, but that would require that we go back, and look at stuff up until that new date. And if you're a large company that has things happening all the time, it's possible that this report will never get released. So what they do sometimes, they'll do what they call dual dating. And dual dating is when you have two different dates. So they'll say, okay, February 5th is the the date of the audit report, except for item J. Item J, the date for that is February 8th. So they'll have dual dating. And even though they call it dual dating, it sounds like two. I've seen them have 5 or 6 dates on it, because especially large companies, things just happen all the time. So it is possible to have more than one date. So dual dating is you'll have a date for field work. Oops. And then you'll have a different date or subsequent events. I'll say subsequent event. Oops. So it's possible you have a February, what did we say it was? 5th. And then you have some, a different event, let's say it happens on February 8th. Hey, how come this one didn't? Oh, there we go. Okay, so dual dating is when you have different dates, and it comes about because the report will never get issued. Basically, they have to keep going back and redoing it to get up to date. So a lot of times they'll just put extra dates. And again, I've seen multiple different dates in for the for the report. Okay, let's go ahead and take a break. Let's say be back at 6:56. Let's say 7:06. We should finish this up pretty soon. Okay. Yeah. Okay. Let me get this on one page. Okay, management representation letter. Management representation letter is something that's given on the last day of field work. It's the last, just about the last thing you do is get the management representation letter. Basically, it's a letter that management signs that acknowledges everything that they've told you up until that point on the audit. And it also reminds them of their responsibility. It must be signed by the, I should put this in here. Let me get back to the, right at the bottom, I'll say it's signed by the, oops. So it's signed by the CEO and the CFO. Okay. And it is there to kind of remind them of what of their duties, but also to get an understanding of, you know, what the things that they told them, what they relied upon during the audit and that sort of thing. Now, if either the CEO or the CFO does not sign it, that is usually a scope limitation that's large enough that they oftentimes get a disclaimer. So if they say, well, I'm not going to sign it, then they generally get a disclaimer because you don't know why they're not signing it. So it's a document that they sign. It's there to reinforce those things that they told you and that they acknowledge taking responsibility basically for the place. If they don't sign it, it's generally a scope limitation. All right. It does not replace any audit work. You still have to have the evidence to back up your opinion. So you can't say, well, we'll just put it, you know, just put it in the management representation letter. Nah, you got to have the evidence to back up your audit. The representation letter is just there to basically check with management saying, is this everything? And so that's kind of the gist of it. You're required to get one of these, by the way. This is not optional. And basically management must acknowledge their responsibility for internal controls. Well, you know, why do we have them do it? It's reduce possibility of misunderstanding. If there is a problem, that it better that it happens before the audit is wrapped up. And it reminds management of their obligations. There are times I've known about that, heard about that. They give them the management representation letter and they say we can't sign it like this, and then they start going into what they need, you know, the bad stuff. So it does sometimes, you know, people will tell you things, but when you put it in writing, sometimes they'll have a change of heart. It's done the last day of field work. Last thing you do, basically, on the way out the door is have them sign this thing. Okay. Management representation letter routinely indicates a statement pointing out that the senior management has no knowledge of any fraud or suspected fraud involving management. So this is a very important one, and you know, this is one of the reasons why if they don't sign it, you are suspicious. Okay, you can read it. Related party issues are only for material considerations. Basically, we're still looking at just material stuff. Okay, so let's go to the lawyer letter. And again, this is generally, it's required in the US. Oops. Other parts of the world, it's not required. Our wacky legal system means we have to require it. Now, when you're getting information on lawsuits, your first go-to is the client. So you'll ask the client about lawsuits and that sort of thing. And the information by the lawyer letter is really there to corroborate what the client has told you. Okay. And again, this letter is required in the United States. You'll talk to their attorney, and their attorneys will generally provide you with the information. Now, the attorneys are not necessarily involved in all of the contingent liabilities and all that kind of stuff. And some of them are not material. They may be, someone falls in the parking lot at Walmart, there's probably going to be a lawsuit, or there could be a lawsuit anyways. But it's probably not enough to be material. And as an auditor, it probably happens every day. It probably happens every day someone falls in a Walmart parking lot. You're not going to get too crazy about that, but the larger dollar amounts you will. So generally you're looking for those things that are material. Okay. And generally this is one of the unusual times, I think the only time that I can think of in auditing, where you'll get together with the management and decide what is material. And you're doing that because the attorney will ask, well, what am I looking for? Yeah, there's 15 lawsuits, but some of them are for $200 and some of them are for $200,000. Which ones are you talking about? And so you get together with the client and say, what is material? Now that materiality amount is probably going to be less than your, tolerable materiality, obviously, but that's one of the few times you'll actually discuss anything about materiality with the client. You generally don't talk to the client about materiality. You don't want them knowing what your materiality is. Okay. The refusal of the client's attorney to provide information requested in the inquiry is considered a limitation on the scope and result in a disclaimer or qualified opinion. So it's very serious, and this is in the United States especially. In other countries, it's not that big a deal. If there is a liability, they kind of know what it is. It's much more cut and dry than it is in the United States. So if the client's attorney refuses to give you information, generally they get a disclaimer because you know what it is. Or it could be a qualified opinion saying, look, we could verify everything except for contingent liabilities with the attorney, if you think that it's isolated, to certain accounts or something like that. Now, generally, the attorney is required to help the client. So the attorney would definitely have the possibility of getting their license yanked if they didn't cooperate, because it does damage the client, and that they may get a worse opinion based on this attorney that's supposed to be helping them. So it is kind of a sticky issue, but if the attorney refuses, it's a scope limitation. We do not go to the attorney and ask them to confirm all of the all of the loss contingencies and that sort of thing. Not all of them require that they be booked. Not all the claims that if they could be immaterial and they could be as part of the normal business and that sort of thing. And basically, you're looking at the things that, and you're also only looking at the items that attorney works on. You don't start asking that attorney, what about this, that, and the other thing? If there's a possible lawsuit that the attorney has not been contacted about and hasn't done any work on, it is not reasonable to ask them about it because they have nothing to do with it. So it's only for those things that the attorneys are actually working on that you're actually asking them questions on. Okay. Communication and misstatements to management. How much more do we have here? Oh, we're almost done. Hey, hey. Wow, we're gonna be done early today. Woohoo. Communication misstatements to management. Okay, actual misstatements. Okay, actual misstatements are the actual amounts that are in error. Which is the actual amounts found by the auditors that are in error. These may or may not be material. Oops. And so, if you're doing auditing and you say, okay, well, we found these, 5 accounts that were misstated, but they're not material. Well, the client might say, well, can we get the information on those? We want to correct them. If you found accounts that are misstated, even though they're not material, we want to figure out why. And by the way, I've been on financial audits. I was an internal auditor. Internal auditors work inside the company, and I worked for Navistar and US Steel. And our external auditors, which at both Navistar and US Steel was Deloitte and Touche, they would come across stuff that's not material to them. Okay, this is off by 15,000. Okay, we're not, me as an internal auditor, though, I would say, okay, what is that? And the reason is I wanted to go, tell my supervisor, like, by the way, here are some things that we need to look at because this was misstated by 15,000. It's not material. It's not going to show up on the financial statements, but we want to improve the company and we want to, make sure that this doesn't happen again or whatever. So oftentimes clients will ask you to, when you find something, tell us, and because we want to correct our books and figure out why it was misstated in the first place. So even though something might not be material, you will oftentimes communicate it with the client, and not that you're requiring them to make the correction, but that they may want it just for their own, if it's immaterial and they don't make the correction, the material doesn't matter to the external auditors. Okay, projected misstatements. And we did this. That's like the classical sampling. Projected misstatements. Are not as persuasive as actual misstatements. And I think I before, if you audit to the 95% level, projected misstatement will be okay. Let me clean this up. Hey, what's it doing? Okay, projected misstatements are not as persuasive as actual misstatements. So even though we come up with projected misstatements and we do it for a reason because we can't take, oops. You know, we're taking a sample of them and projecting it. Audit to the 95% level, the projected misstatements will be wrong 5% of the time. So they're not as persuasive of evidence. And also notice something about projected misstatements. If you have an actual misstatement, let's take accounts receivable. You have an actual misstatement. You can say, okay, you know, here your account for, you know, Fred is off by $10,000. Here your account for Sally is off by $13,000, whatever it is. Those they can actually go in and make corrections for. So if it's accounts receivable, they go, okay, okay, those accounts are off. Okay, I get it. Those accounts are off. We're going to go change them, even if maybe they're not even material, but we want to update them and see why they were off. Projected misstatements. If you say, okay, you know, the entire accounts receivable is off by 120,000, that could be a problem because they can't just go in and arbitrarily start knocking off accounts for 120,000. They don't know which ones they are. And even if your sample is reflective of the population as a whole, you still don't know which ones they are. You know, there's a problem there because, you know, so it's not as good of evidence. And also, if there is to be an adjustment made, it's usually made differently than if it's an actual one. You probably end up putting on some kind of a estimated uncollectible, you know, bumping up the estimated uncollectible or something like that to reduce the amount of accounts receivable. Again, you don't know which ones are misstated, you know, and overall the material misstatement, you don't know which ones are, even if it's a good sample, you don't know which ones are. You can't just start writing off the accounts. Where the actual ones you can. Okay. Review of the engagement. Both the AICPA and the PCOB require reviews of the audit engagement. And you know, so review of the audit by objective of audit professional is required. And this is the same for the PCOB. PCOB has a few more hoops to jump through, but same thing. Now there is a difference. You say, okay, well, those look the same. What does it matter? Okay, here's what matters. This review may be completed after the audit report is released. So you would release the audit report and later on, a month later, whatever, someone takes a look at it and just to make sure that everything is okay with it. Okay, so PCAOB, you could probably guess what happens here. This review must be completed before the audit report is released. So PCOB, and again, you know, these are bigger, these are usually smaller companies, not always, but that look funny. And these are usually larger businesses. Okay, so Larger business, so publicly traded companies, issuers, they have to have it done before the audit report is released. So even though they have the review, and they actually have a few more hoops on the review, but the review must be done before the audit report is released. Whereas it can be done after for non-issuers. And again, the stakes are higher for the issuers often. You could have millions, if not billions of dollars riding on the report. So you want to make sure that it has been reviewed by somebody before it is issued. Whereas this one, maybe there's only, one or two or a handful of people relying on the report. If there was something wrong, it wouldn't be like you had to major upheavals or whatever. Okay. Other information in the annual report. Gotta check something. I don't know if I have it in here or somewhere else. I'm sorry, give me one more second. Let's see, it might be in my permanent file. Okay, GE annual report. Let me pull this up. So this is the General Electric annual report. And a lot of things in here, blah, 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 blah. About halfway down, they'll have the financial statements. Here's the financial statements. Okay, so there's a lot of stuff in this annual report. Now, what if there is information in the annual report that does not match the financial statements? They have all the they have hundreds of pages sometimes in these. I've actually seen the 10K is what they do for filing with the SEC, and a lot of times companies will issue that as their annual report, and they'll have 5 or 6 pages of income statements, and I've seen them that have had over 800 pages of information in them. So what happens if the stuff that's in the financial statements that you have audited, you put your stamp of approval on, or the audit opinion on, what if there's stuff in that annual report that doesn't match what you have in your financial statements? For example, let's say the financial statements show that they have revenue of 230,000, and you start reading through their annual report. Let's make it bigger. 230 million, let's say 230 million. You start reading through the annual report, and they have sales of, they say that they have sales of 270 million. Okay, so the number they're showing a different part in their annual report doesn't match what's actually on the financial statements. And your financial statements are included in this document, and this document could be misleading not because of what you reported on. What you reported on, you're fairly comfortable with, but they're using different numbers in it. So what do you do with that? What do you do if they have different numbers? So does not match the audited financial statements. The auditor has 3 options. Okay. first one, withhold the report. I think there's actually two. I think it looks like this. Yeah. So withhold the audit report is one option. Two, hey, how come I didn't jump over? Withdraw from the engagement. It's kind of a drastic one. And three, note the discrepancy in the audit report. So change the audit report to reflect the discrepancy and put the dollar amounts in and why it's misleading. Oops, hey, how come that didn't change? There we go. Okay. Form an opinion and issue the report. Based on the audit evidence. And that's the last thing that you do. All right. Question on that? Okay, we're not going to have any multiple choice questions. I'm going to ask you essay questions. There's going to be, I think I have 6 of them. Essay questions. I'm going to give you scenarios that are similar to type 1, type 2 based on this chapter. I'm going to give you also scenarios based on, like, for instance, how do we ensure that when we audit inventory, how do we ensure that we count everything? How do we ensure that we count everything only once? Those sorts of things. Those kind of specific how-tos as far as what we do, because that's kind of what this course is about how the actual practice of auditing, what do you actually do in auditing. So you're going to get certainly type 1, type 2 type stuff, because that's wrapping up the audit. You're going to get something on looking for unrecorded liabilities, chapter 16. And a couple, probably like a couple essay questions out of each chapter. And I'll send that out. I might get it out tonight, but certainly by tomorrow I'll have it out. Any questions on any of this? Okay, I will be here in class next week. If you don't have anything that you need to talk to me about, or well, you're welcome to come. Don't think I'm like brushing you out the door, but if you have anything you want to talk about, or anything you want to go over, if you have anything to make up, anything like that, we can talk next week. And I will be here in class next week if you need to attend next week. And that's it. Any questions? All
Are
right.
there any additional homework assignments?
Well,
Or
this
This,
one will be turned in, and then let me. Give me 1 second. Let me sign into my the only thing we need to turn in the chapter 16 handout like we just did. And then the chapter 12, 13, and 16 exam. Let me log into Blackboard. Well, that was easy. Oh, I know why, because I'm logged into the yeah, so this is the, by the way, I think I told you guys this. I changed the weekly lessons things because it was too confusing. I should hide all the rest of this. If you look at all documents, this is what I'm going to be. So
All right, I was prompted to ask the question. Oh, I see it there, a handout for chapter 16. So we turn that in, and then you're gonna email the exam, correct?
yeah, I'm going to email the exam out
Okay.
here. Yeah, I put I'm going to take away all this other stuff. That was I should have stood up for myself earlier this semester, but I didn't. But anyway, yeah, so that they're all in one place. I just like having everything in one place. You look at one, trying to figure out which week it is. That's too much of a pain.
No, it's fine. I got it. It was just an oversight on my part. I see it at the bottom now that we 16 handout and then the exam is right below. I got it now. Thanks.
Yeah, but yeah, just so you know, in the future, if you have me for any of these classes, I am not going to do the weekly thing. and they say, well, they have to know what to do. It's like, well, yeah, that's why we put the dates on it. It's not rocket science. Okay, so everything needs to be turned in. The last day of the semester is December 16th, which is a week from tomorrow, a week from Friday, I think, is the last day to turn in stuff. And that's not just this class, but your other classes too. But I will send out that the chapter 12, 13, and 16 exam, and you can turn it in Blackboard, and I will clean that section up tonight so that it's not as confusing. Any other questions?
So you said there's going to be 6 essay questions for the test?
Yeah, I'll probably put a couple from each chapter, a couple from chapter 12, which is the inventory, a couple from the property, plant, and equipment chapter, and then a couple from chapter 16. Yeah, but probably a couple from each, and those will be essay questions. The essay questions I think are a little bit better because they give you a little bit more of a chance to explain stuff. Any questions? Okay, well, if you do have any questions, feel free to contact me. And again, I will be here next week. You're not required to come, but if you would like to, or if you need help with something, whatever it is, I will certainly be here. There will not be any new material covered next week, but I will certainly be here. Okay, any questions?
Okay,
Thank you,
thank
Professor.
you. Have a good night.
Good having you guys. Good having you.
Thank you.
See ya.